Dividend investing can truly be as easy or as complicated as you want to make it. Now, what I mean by this is that you can, of course, spend days and days researching single name stocks and try to time the perfect entry point to start a brand new position on a stock and lock in a nice starting dividend yield. Or, of course, as an investor, you could take a dumber, more simple approach that, believe it or not, a lot of newer investors seem to miss altogether. Now, in this video, we're going to go over why many times the dumber investors seem to make all the money when it comes to long-term investing, and exactly how they're able to do this step by step. Now, if you happen to be a long-term dividend growth investor, make sure to stick around because I promise you are not going to want to miss out on this information. I just finished my brand new dividend investing ebook where I share exactly how I went from zero to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, let's be real, as newer dividend growth investors, you or I remember going through a list of different stocks and basically sorting them from highest yield to lowest yield and picking the few names, the few companies that we thought were going to send our portfolio to the moon. Now, I was definitely guilty of this, and I picked a few different names, AT&T being one of them years ago. And generally speaking, earlier on in my dividend growth investing journey, I was pretty much just buying into single name companies if they offered a nice starting dividend yield. Now, the reason why doing this single stock picking can be, generally speaking, very risky for especially newer investors is because, of course, when you are purchasing a single stock, or let's say even a group of them, your overall portfolio is, of course, not all that diversified, and if 1, 2, or 3 of the names might have a bad quarter or a bad year, newer investors can see their portfolio tank because they just don't have all that much diversification in their portfolio. And unfortunately, a lot of the newer dividend growth investors don't understand in the early days, or maybe just completely ignored altogether like I did back in the early days, that there's a much better approach when it comes to long-term dividend growth investing. And in my opinion, it's definitely investing into a high quality dividend growth ETF. Now, a dividend growth ETF is basically an ETF that has a basket of stocks within it. Some of these ETFs even have hundreds of different stocks in one single name. And with dividend growth ETFs, they all have a few things in common. They all do pay a starting dividend, which is great, especially for the more dividend income focused investors out there, like a lot of you that are probably watching this video right now. But also because they do have the growth aspect. These ETFs also, generally speaking, pay more and more in dividends over time. And although I know in the early days of investing, a lot of these different things that I'm going over in this video might not seem all that important, but I promise you, please take what I'm saying seriously. Because now, around 7 or 8 years since I started dividend growth investing, these are the things I wish I knew right off the bat. Now, one of the metrics that's very important, and of course that has a lot to do with dividend growth ETFs, which is the simpler, dumber way to invest really, is the metric dividend growth rate. Now, dividend growth rate is pretty simple. It's basically how much an ETF or stock pays in dividends annually compared to the previous year. So like a basic example, if a stock or ETF, let's say, paid $1 in dividends in 2023 and then paid $2 in dividends in 2024, the dividend growth rate would be 100%. Now, over time, you're going to realize that a lot of different stocks across the market, as well as ETFs, have a dividend growth rate of somewhere of around maybe 1, 2, 3, maybe 4 or 5%. And I would say personally, a good rule of thumb is anything that has a long-term dividend growth rate north of 5% is definitely something that should get your attention. So the reason on why I think that dividend growth rate, that simple metric, is such a cheat code when it comes to long-term dividend growth investing is simply because of this right here. If you look at this graph right here of every single dividend payment on a quarterly basis that the SCHD ETF, for example, has paid since the inception of the ETF, you can see one thing that's very specific. Over time, the SCHD ETF has paid more and more in dividends on a quarterly basis at a pretty impressive rate. Now, to give you a visual example of an ETF that does not have dividend growth, just to show you how it looks, the QYLD, the Global Nasdaq 100 Covered Call ETF, has been paying dividends on a monthly basis for quite some time. And here's every single monthly dividend that this ETF has paid since the inception of the fund. Now, if you go back in time in 2014, this fund was paying around 19 cents per month per share, 21, 26, and pretty much everything else in between. Now, around 10 or so years later, this ETF is paying around 16 cents per share, 17 cents, 18 cents per share. Now, keep in mind, this ETF has an entirely different strategy, and I'm not saying that this ETF in any way is even comparable to that of something like SCHD. But just to give an example, a visual of what a lack of dividend growth looks like, this is what it looks like right here. Now, this is going to be extremely important, especially for those longer term investors out there that are interested in building a massive portfolio, maybe not within 1 year, 2 years, but maybe 10, 20, or even 30, 40 years. Now, the power of compound interest is going to grow substantially faster if you are investing into an asset that is also paying you more and more in dividends year over year. Now, you might be asking me at this point, well, what's an actual example of an ETF that does offer dividend growth and is also well diversified? And for this example, we'll look at the SCHD ETF or the Schwab US Dividend Equity ETF. Now, going back to dividend growth for a second, you can see that over time, every single quarter that SCHD has paid a dividend, at least historically speaking for the most part, has continued to get larger and larger and larger. Take 2014, for example. Back in December, SCHD paid 28 cents on a quarterly basis, where just as of recently in December, now SCHD is paying 74 cents on a quarterly basis. Now, simply put, this means that for every single share that you owned back then, you are basically getting paid more and more and more over time, which is only going to help when it comes down to building a compounding machine of a portfolio. But it's not just SCHD. There's tons of other super simple, easy ways to invest into dividend growth ETFs. Like take VIG, for example, the Vanguard Dividend Appreciation Index, another super high quality ETF that has over 300 different holdings in it. Some of the holdings being things like Microsoft, Apple, United Health Group, tons of super high quality blue chip stocks. But with investing into something like VIG, again, just as another example, you're getting almost a 2% starting dividend yield, but the dividend growth rate, again, how fast the dividend has grown over time, has been substantial. To give another example, VIG back in December was paying around 40 cents in dividends, and now just as of recently, almost 80 cents in dividends. Not to mention ETFs like VIG and SCHD have also grown substantially in ETF price year over year, at least over the long term. Now, lastly, I want to go through a few more of some of my favorite dividend growth ETFs that you guys should definitely look into. And once again, I'll repeat what I said earlier. If you are a relatively newer investor that's building out a long-term dividend growth portfolio, and you're picking single stocks for your portfolio, in my personal humble opinion, I think that could possibly, of course we don't know what's going to happen, but I think possibly that could be a mistake, because investors that are buying into things like DGRO, the iShares Core Dividend Growth ETF, ETFs like VIG that we saw a second ago, and even ETFs like SCHD, investors that are buying into dividend growth ETFs like those are not only getting exposure to some of the biggest, highest quality companies, stocks in the world with just a click of the button, but they're also buying into high quality dividend ETFs that are diversified, offer a nice starting dividend yield, some more than others of course, and also for those longer term investors out there, I promise you, dividend growth rate, or how much year over year in dividends an asset pays, is going to be a very important metric, especially 3, 5, 10, 15, 20 years down the road. So by all means, if you want to be a single stock picker, and keep in mind, I definitely have tons of single pick stocks in my portfolio. I'm not saying that you shouldn't have a diversified portfolio with a little bit of everything, but I promise you a portfolio of single pick stocks, especially from a newer investor. And keep in mind, you're most likely going to get better at single stock picking over time as you just become more and more aware of the market and as you learn more. But for newer long-term dividend growth investors that do have a long timeline ahead of them, I think investing into single stocks could be a massive mistake in the context that there's so many high quality dividend growth ETFs out there that would really allow an everyday brand new dividend growth investor to build a super solid foundation for their portfolio long term. But now I want to hear from you guys down below when it comes to building out a long-term dividend growth portfolio. Do you personally prefer single stock picking, or are you someone that buys into dividend growth ETFs like the ones that we showed you in this video? Over the past 4 or so years now, I've been buying shares of the Global X Nasdaq 100 Covered Call ETF, known as ticker symbol QYLD. So many shares to, as of right now, filming this video, I currently hold around 2,734 shares of QYLD, which I paid around $19.77 per share across the board. Now, if you add that all up together, that's over $50,000 invested in just QYLD, which, like I said, I purchased over a span of, say, 3 or 4 years. Now, in this video, we're going to look a little bit deeper into QYLD and explain exactly why I purchased so much of this ETF in the first place. I'm also going to share exactly how much I receive in dividend income on average on a monthly basis from this ETF. And then stick around towards the end, because I'm going to share my current thoughts of QYLD in 2024, and if or if not, I still think this ETF is a good buying opportunity for income-focused investors. So stick around, drop a like down below, and let's get right into this one. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So like I was sort of saying in the intro, I do own around 2,734 shares of QYLD across multiple different portfolios, and by no means did I purchase all these shares of QYLD at one time. I purchased tons of shares in 2020 and 2021, and it's honestly been a while since I purchased a lot of QYLD, although just as of recently, in the last month or two, I did grab a few more shares. Now, real quick, for those investors that aren't super aware of what QYLD or how this ETF even works, it's a typical covered call ETF. And it says right here on the website, reasons to consider it: high income potential, monthly distributions, and efficient options execution. It says QYLD seeks to generate high income through covered call writing, which historically produces higher yields in times of volatility. QYLD has made payments to investors in the form of distributions for 10 years running straight. And QYLD writes call options on the NASDAQ 100 index, saving investors time and potential expense of doing so themselves. Now, some more interesting facts about QYLD: the total expense ratio is about 0.61%. So because of the strategy and the management involved, QYLD, along with a lot of other covered call ETFs, is going to cost you a little bit to own. There's also almost $8 billion in net assets, so this is one of the largest covered call ETFs across the entire market. Now, another very interesting and probably a very important fact about QYLD to a lot of you dividend or income focused investors is the way that QYLD's distributions are taxed potentially. Now, this is as of February 2024, so a few months back. Now, it breaks down the distributions and how they're taxed. And as you can see right here, return of capital. This is a very important aspect. QYLD's percentage breakdown of current distribution is around 96.79% return of capital, which could definitely be an efficient tax method for some investors looking to kick the can down the road when it comes to taxes. But even with all that, QYLD is definitely far from a perfect dividend or income focused ETF. As you can see right here in the max time frame, this ETF is down around 30.5%. And like I said towards the beginning of the video, I own a ton of QYLD at just around a $20 cost basis, which means I'm down pretty significantly as far as ETF price if I were to go to sell my shares today. But of course, real magic with QYLD is that monthly dividend that has been paid now for 10 years running, which at least as of recently is somewhere around 16 to 18 cents per share per month, which definitely has added up nicely now that I'm just sitting around 3,000 shares of QYLD. Now, the reason QYLD doesn't pay the same amount every single month is because this ETF strategy and of course the different volatility in the markets and in the option premiums. But all in all, QYLD keeps paying what it's paying at right around 17, 18 cents per share per month. We're talking somewhere around a 10, 11, 12% trailing 12-month yield, which is pretty massive. And even though a lot of investors give QYLD sort of a bad rep, because even though the ETF pays a nice juicy dividend every single month, the ETF has of course decayed substantially over time. Even with that said, all in all, if an investor would have invested $10,000 into QYLD back during the start date in 2013, when QYLD was trading at $25 plus per share, now around $17. Because of those nice juicy dividends, an investor still would have had a total return of around 97% over around 10.36 years, or an average total return just shy of 7%. Now, I am by no means saying that a 7% average total return is the best thing across the entire market, but I will say for those investors that are more focused on cash flow today and build out an asset that's maybe going to help them pay some of their bills or maybe help them retire early, QYLD is definitely not the worst investment I've seen across the entire markets. Considering there's definitely yield traps out there like TSLY, for example, which started at $40 per share, now trading at $12.98 per share. And even though TSLY has paid massive dividends basically every single month since this ETF started, an investor would have had a total return of minus 27.78%, and that's with dividends reinvested. So all in all, has QYLD decayed like crazy over the past, say, 10 or so years? And on top of that, am I down on my shares of QYLD as of right now? If I were to go to sell the shares, yes. But has QYLD paid me every single month a ton of dividend income and allowed me to reinvest that money into different things like realty income, like SCHD, or even DGRW? The answer is also yes. And if I were to take QYLD's sort of average dividend that we've been seeing over the past few months of around 17 cents per share per month and multiply that dividend with my 2,734 shares of QYLD, which I currently own as of right now, we're talking about across all my portfolios where I own shares of QYLD, around $464.78 every single month, more or less, and again in a sort of tax efficient manner if that's what you're looking for. Now, I'm personally not doing this by any means, but if I were to take those dividends and reinvest every single dollar that QYLD pays me on a monthly basis, I could then buy around 26 more shares of QYLD, which then next month will each pay me around 17 cents more per share, which will raise my dividend income from just QYLD up around $4.41 every single month ongoingly, and that's only going to get bigger most likely. So is QYLD my favorite position throughout my entire portfolio? And is this a position that I'm going to buy a ton more shares of anytime soon here? The answer to that is no and no. But is QYLD a position that I'm down slightly on, but getting paid handsomely along the way, and allowing me to generate a ton of income to reinvest into more different dividend paying stocks and ETFs on a monthly basis? The answer to that is yes. So moving forward, the final thing I want to talk about is if or if not QYLD is offering a buying opportunity in 2024 for more dividend income focused investors. The answer to that would be maybe. And I say maybe because it's not the worst covered call ETF across the entire market in my opinion, but there's definitely better covered call ETFs out there in my opinion. The JP Morgan Nasdaq Equity Premium Income ETF, which I own 508 shares of, or even a newer covered call ETF, which I've been in love with as of recently, ticker symbol SPYI. But if QYLD does dip a little bit further from here, will I average down maybe a small amount to lower my average cost per share? It's definitely possible. But more importantly, I want to hear from you guys down below when it comes to QYLD, the Global X Nasdaq 100 Covered Call ETF. Is this an ETF that you currently have in your portfolio? Let us know yes or no, or why or why not. In case you haven't noticed as of yet, across my YouTube channel, I often talk about different dividend paying stocks and ETFs that pay dividends on a monthly frequency. Now, the reality is whether or not a stock or ETF pays a dividend every single month or every single 3 months arguably doesn't make all that much of a difference. And as you can see throughout my long-term portfolio, I do own several different stocks and ETFs that pay both. But in this specific video, we're going to go through 3 reasons on why I think that monthly paying dividend stocks could be much more favorable to certain dividend growth investors compared to dividend stocks and ETFs that pay quarterly. So if you're ready to dig into this with me, make sure to drop a like down below, stick around, and let's get right into the first reason. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, before we go through these 3 specific reasons, like I said a second ago, it doesn't really matter if a stock or ETF necessarily pays a dividend monthly or quarterly, because at the end of the day, if a stock pays you 15 cents every single month and a different stock pays you 45 cents every quarter, well, it's basically more or less the same amount of money. But there are still some specific reasons on why I think monthly paying dividends could be better. Now, the first reason on why I think monthly paying dividend stocks, or ETFs for that matter, could be better than quarterly is this right here: the fact that faster cash flow could offer faster purchasing power within your portfolio. Now, what I mean by this specifically, let's take a look inside my actual dividend growth portfolio. We have right here, for example, 1,000 shares of Apple, which of course Apple pays a dividend on a quarterly basis. Then just below Apple, we have 2,734 shares of the QYLD ETF, which pays on a monthly basis. Now, if you're a dividend growth investor like myself that's looking to receive as much dividends as quickly as possible to then, of course, redeploy into more shares of different dividend paying stocks and ETFs to really get the compounding snowball effect happening within your portfolio. If we're just for a second only looking at that aspect, which of these 2 assets are going to get cash faster in your portfolio on a yearly basis? Well, it's going to be the monthly payer QYLD. Now, of course, I'm not saying that the QYLD ETF is a better investment than Apple stock, but I am just making the point that on a cash flow basis, getting more cash into your portfolio ASAP. So as a dividend investor, you can get that money invested much quicker into more different dividend paying stocks and ETFs. Well, in this case, the monthly payer would win. The next reason on why I think monthly paying dividend stocks could be favorable for some dividend growth investors, and especially speaking for myself, is the psychology involved in it. Now, when it comes to long-term investing, especially building out a long-term dividend growth portfolio like I have right here, I truly do believe that strategy and psychology play a bigger role in your overall investing career than a lot of people like to give credit to. Now, for example, that's why I always tell newer investors to track your dividend income in a dividend tracker like this one, or of course you can build your own, it could be whatever. But the psychology behind getting dividends on a monthly basis and or tracking your dividend income on top of that is going to give you as an investor a lot more motivation behind putting more of your hard-earned active income into investments. Now, at least for me personally, if I buy a share of Realty Income, I know that next month I'm going to be receiving another 26 cents more or less in dividends. Where on the other hand, if I of course buy a share of Apple, and let's say the ex-dividend date just passed, I'm not going to receive a single dividend from Apple for about 90 days. Now again, not trying to compare Realty Income to Apple, those are two very different investments, and side note, I honestly love both of them. But I do think that the psychology behind a monthly paid dividend stock or ETF, knowing that if you invest in said stock or ETF that pays monthly, you know that within more or less the next 30 days, you most likely are going to get paid out from that asset. And especially during my early days of investing, this was super motivating because I realized that if I could take some of my hard-earned money, let's say it's $100 or $200, and buy, for example, a few shares of Realty Income, I could literally see cash flow, even if it's just 50 cents or so, 75 cents, I can literally see cash flow entering into my portfolio within the next month or so, which was very motivating, especially for more dividend income focused investors like myself. Now, it goes without saying that if you're more of a growth investor, this is not necessarily going to help your psychology because you don't really care necessarily about getting 26 cents, 50 cents. And honestly, a lot of things I'm talking about in this video might not necessarily make sense to you. But for those dividend growth investors like myself that like to look at every single penny, entering and of course exiting their portfolio, the psychology and mindset that go along with the monthly paid dividend stocks or ETFs could definitely be beneficial, especially if you are really hands-on in your portfolio like I am. Now, the last and final reason I think that monthly paying dividend stocks and ETFs could possibly be favorable compared to quarterly ones is the idea of living off your dividends completely. Now, I've showed you guys my long-term portfolio many times on this channel, and I even showed it to you just a second ago. Those are different dividend stocks and ETFs that pay me dividends every month and or every quarter. And in the future sometime, at some point after I stop reinvesting into more dividend paying stocks and ETFs, I'm going to be looking to use those dividends for some of the following things. I'm talking things like rent, groceries, maybe a mortgage payment, daily incidentals, things like clothing, things like travel, etc., etc., etc. This right here is just a small list of some typical monthly expenses for humans. Now, if we're trying to build out a long-term portfolio that pays dividends, of course, and we're looking to use those dividends to live off of in the future, I'm not saying that if a stock or ETF pay quarterly, that it's impossible to live off the dividends. Obviously, in my long-term portfolio, I have tons of holdings that pay quarterly, and obviously you just need to do some budgeting and make sure you have the cash on hand. It's not that big of a deal. But there still is an argument as far as cash flow goes, that if you are receiving at least a good amount of dividend income every single month, you're going to be able to take care of things like rent, like groceries, like other things on this list. Because let's be real here, rent is not paid quarterly, a mortgage payment is not paid quarterly, a credit card bill is not paid quarterly. And like I said, I fully understand you can just budget and keep the cash balance and wait till the bills come up if you are paid quarterly through dividends. But for someone like me that's a little bit OCD about budgeting, and for someone that likes to run things on a cash flow basis, owning assets that pay you monthly is possibly going to be a little more favorable when it comes time, hopefully sometime in the future, where we all can use our dividend income to pay for our bills. Now, if you're personally building out a dividend growth portfolio that you're planning on maybe selling off in the future to use that money to live off of, or maybe you're not even looking to use this portfolio to live off the dividends at all, well, then this of course doesn't really apply to you. But for those investors like myself that are truthfully trying to build out a portfolio to surpass their monthly expenses, and then sometime in the future look to use their portfolio's dividend income every single quarter, every single month to pay for their bills, I think dividend paying stocks and ETFs can come in extremely handy when it comes time for that. So there we have it, guys. Those are 3 different reasons on why I think potentially dividend paying stocks and ETFs that pay monthly as far as dividends go could be favorable to those that pay quarterly. Now, of course, I would never purchase a different stock or ETF solely because they pay a dividend monthly versus quarterly, but I do think that it's something important to think about, especially when building out your specific strategy when it comes to dividend growth investing. But now lastly, I want to hear from you guys down below. Do you agree with me that dividend paying stocks or ETFs that pay monthly could be favorable long-term to building out a portfolio, or do you think quarterly dividend paying stocks ETFs are just as good? Let me know in the comments down below. 3 top dividend growth ETFs that all pay dividends monthly and have a ton of growth potential on top of it. Which 3 are my favorite as of right now? Stay tuned to find out. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So the first monthly paying dividend ETF that has growth potential, pays dividend monthly, and is one of my favorites as of right now. I own tons of shares of this one. It's ticker symbol DIVO or DVO, the Amplify CWP Enhanced Dividend Income ETF. Now, DVO in a nutshell basically buys a small basket of holdings and also utilizes an option cover call overlay on individual stocks to generate a ton of income for investors. Now this, like I said, not only generates more income in the form of dividends, but also right here it says seeks to lower volatility. So during times of the market turns sour, DVO definitely has some downside protection because of that cover call overlay. Now, because of that cover call overlay, DVO is not necessarily a rocket ship in the form of growth, but this ETF has consistently moved up and to the right at a slow and steady pace over time, all along while reducing volatility in your portfolio. DVO is up around 53%, and this is since around 2016. DVO has an expense ratio of 0.56%, which is a little bit on the expensive side, but this is because the cover call overlay can be management intensive. But with DVO, you are getting exposure to some of my favorite companies across the entire market. We're talking things like United Health Group, we got Microsoft, Caterpillar, Walmart, Visa, the Home Depot, Procter & Gamble, and the Goldman Sachs. All in all, around 46 different positions, so DVO does have a smaller basket of holdings, but with that cover call overlay, you're still overly diversified if you ask me. Now, even though DVO does have exposure to some of those names that we just went through that don't necessarily offer a massive dividend yield, because of that cover call overlay, DVO is able to offer investors around a 4.5% starting yield, which is much higher than that you would get with other ETFs that are exposed to those same names. Now, every single month, more or less, DVO pays around 14 or 15 cents and has been paying dividends to investors for years. DVO has been great in my portfolio. I've held onto it for years. It's not necessarily the most popular dividend income focused ETF, but definitely check it out if you haven't already. My next favorite ETF that pays dividends monthly and also has growth potential and is on the top of my buy list as of recently is ticker symbol DGRW, or the Wisdom Tree US Quality Dividend Growth Fund. Now, DGRW compared to DVO definitely has much more growth characteristics, and this is because this ETF does not have a cover call overlay. What's cool about this ETF though is that you're exposed to names like Microsoft, Apple, AbbVie, a lot of these mega companies that pay dividends quarterly, even though the trailing 12 month is only 1.68%. Because of how well this thing has performed as of recently, it still is a decent amount of cash flow, and as you can see over time, the dividends have been going up and to the right. Now, as far as DGRW's holding breakdown, I'm a huge fan of how these sectors are sort of broken apart. I like the fact that technology is the majority of this ETF, although it's not the entire ETF. Then we have a ton of healthcare, industrials, and a ton of names in the top 5 holdings that I'm a huge fan of, and not for a second would I mind having even more exposure to. All in all, ticker symbol DGRW, the Wisdom Tree US Quality Dividend Growth Fund ETF, is one of my favorites, and after I build out my position of SCHD, this one is definitely going to be in my portfolio in most likely large numbers. The last ETF that I'm a huge fan of that pays dividends monthly but also has upside potential as far as growth and is also on my buying list is ticker symbol JEPQ, or the JP Morgan Nasdaq Premium Income ETF. Now, at this point, most of us dividend more income focused investors are very familiar with JEPQ. And this more income focused ETF has shocked the dividend community over the last year or so, considering even with the cover call overlay, because of the holding breakdown, JEPQ is up 16% over the 1 year. And that's not even including the massive dividend this ETF pays. The ETF is mostly exposed to technology at almost 50%, which definitely helps with the upside potential this ETF has. But along with that 16% or so return as far as ETF price, JEPQ also has a 9.4% trailing 12-month dividend yield. Not to mention the last few dividends that JEPQ paid were substantially larger than the previous. Now, of course, I wouldn't consider JEPQ or DVO necessarily growth ETFs, considering income is literally in their name. But although over the last year, JEPQ's performance, just as far as price return, has outperformed many other growth ETFs across the entire market. All in all, if you're looking for a monthly payer that pays a juicy dividend every single month and also has upside potential, JEPQ should definitely be added to your list. So there we have it, 3 different dividend ETFs that all pay dividends monthly and also on top that have upside potential. Now, DVO, DGRW, and JEPQ have all been on my shopping list on a weekly basis for a while now. Although I have to be honest, out of those 3, I've been grabbing the most shares of DVO over the last few months. But more importantly, I want to hear from you guys down below. If I were to ask you which is your favorite out of DVO, JEPQ, and DGRW, Now, when it comes to dividend investing, the JP Morgan Equity Premium Income ETF is one of the most popular ETFs for more dividend income focused investors like myself. Now, this is because this ETF doesn't only yield about 7% as of right now, but also has paid dividends on a monthly basis for several years now. On top of that, because of the cover call overlay, this ETF is very defensive when the market turns red. And for me personally, I am a huge fan of JEPI. I own over 1,200 shares and have been buying shares of JEPI for several years now. But in this video, we are going to dig deep into a newer dividend income focused ETF that offers not only very similar attributes that JEPI offers, but even offers some things that in my opinion are better, which is why as of recently, I have no longer been buying shares of JEPI and have been buying this other dividend focused, income focused ETF instead. So if you're an income focused investor and want to learn more about this ETF that not only pays a ton of dividend, but offers even more than that than JEPI, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So I'm sure by now some of you guys might have guessed it, but the ETF that we're talking about here is SPYI, or the NEOS S&P 500 High Income ETF. Now this ETF is very similar to JEPI along with other cover call style ETFs. But like I said earlier, this ETF offers some things that JEPI does not offer. But before moving any further ahead, I think it's safe to say that we should dig deep into this ETF, figure out exactly how it works, and I'm going to explain to you exactly why I'm such a massive fan of this ETF, and why I think if you are a more dividend income focused investor, you're going to be also. So first of all, right here on the NEOS website, it says looking for high monthly income. And I would say yes, who isn't? The NEOS S&P 500 High Income ETF, or ticker symbol SPYI, aims to offer high monthly income in a tax efficient manner with the potential for upside capture in rising markets. Now, some of the objectives are to seek high monthly income in a tax efficient manner, and also on top of that have upside potential when the market turns bullish. Now this is also kind of cool. It shows that since inception, the NEOS S&P 500 Income ETF, or SPYI, has outperformed some of the largest income-focused ETF peers, and some of these are very popular. And just for full transparency, I personally hold everything in here. So you can see that the blue is total returns. This is dividends plus price return included. SPYI almost has a 20% total return, where QYLD has over 12%, JEPI has 16%, DVO has almost 16%, and SPYI, of course, the king of all ETFs, has almost 30%. Now, one of the other reasons I wasn't exactly sure about how much SPYI I wanted to add to my portfolio long term is because a lot of these higher yielding ETFs, although many times offer nice juicy dividends, they seem to decay in price over time, meaning that, for example, if you buy a share for $50, even if it pays a 10, 11, 12% dividend yield, if a year later the ETF is trading at $40 per share, you didn't really gain anything. If anything, you lost money. But so far, since around 2022 at least, so keep in mind this ETF still is relatively new, the ETF is up 3.33%, which I hear you, it's not all that much, but it is in the green, and we haven't seen any major decay, at least as of so far. Now, to dig a little bit deeper into how the SPYI strategy works, it says right here, number one, the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven cover call option strategy. So very similar to other cover call funds out there. In this case, we're talking about the constituents of the S&P 500 index, which of course are great holdings. I don't think any of us would really have any problem with having more exposure to the S&P 500. And then on top of that, the fund manager uses cover calls to, of course, generate premium, which is paid out in the form of dividends. But that's not all this ETF offers. Listen closely. It says actively managed by NEOS, the fund takes advantage of tax loss harvesting opportunities, in addition to utilizing SPX index options, classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Now take my word for it, as you build your portfolio over time, and I'm sure a lot of you are already very aware of this, you're going to want to think about taxes because, of course, as you start to generate a ton of dividend income, for example, they might not be taxed very favorably. Now, number three, this is also one of my favorite parts about this ETF, and this is another reason why I really decided on going a little bit bigger in this ETF moving forward. It says the fund utilizes a call option strategy. Not selling options, but buying call options that may include both sold and purchased SPX index options, which may provide the opportunity for upside capture in rising equity markets. So one of the main problems with a lot of these different cover call ETFs is that when you sell a cover call, your upside is basically capped. If the underlying moves up very quickly, you're not going to be exposed to all the upside. But with SPYI, because at times they are also buying call options of things like SPX, that means that if and when the market turns bullish, you're going to have potential exposure to the upside taking place in the market. Now at this point, we're sort of getting into the weeds, and I really don't like talking about taxes all that much on my channel because I think that taxes are such an individual situation that can be so different, determining many different factors, but also looking at things like this right here. Just for an example, it is in connection with the monthly dividend payment of 47.5 cents per share that was paid back in January 2023, just for an example. It shows that 94% of such dividend will be return of capital. Now, return of capital is going to be taxed differently than ordinary or non-ordinary dividends, etc., etc. And like I said, I'm not going to go super deep into that, but just know that SPYI could be a perfect ETF with a great tax strategy for your portfolio, depending on what your needs and wants are. So we talked a little bit about SPYI, what this ETF is and how it works. We even talked about the total return so far next to some of the other popular cover call style ETFs and some of the main reasons on why I'm personally so attracted to this ETF as of right now. But now looking into the fun part, looking at the dividend for SPYI. We're talking an 11.67% trailing 12-month dividend yield, which is much higher than most other covered call ETFs across the market currently, and of course much higher than basically all blue chip dividend stocks. Now, what's also impressive and something that I was very eager to see how this was going to play out long term is if or if not SPYI was going to offer a consistent monthly dividend. Because some of these covered call funds, things like JEPI or even JEPIQ, due to volatility in the market and due to the different pricing when it comes to premiums in the option market, some of the covered call ETFs pay a very drastically different dividend, which all in all is fine in most ways, but it is very nice to be able to sort of have an idea of what you're going to get paid next month and the month after that and the month moving forward. Now, of course, take this with a grain of salt. SPYI has not been around for that many years or even that many months and has not paid that many dividends compared to some of these other covered call funds, etc. But since the inception, SPYI has paid a very steady 46, 47, 48, or 50-cent dividend every single month since the ETF started. Now, just because SPYI paid this in the past does not necessarily mean that it's going to continue to do so forever, of course. But it looks to me like there's a certain cadence here, and it looks like the fund managers are doing what they can to make sure investors are getting right under 50 cents, more or less, per month, every single month, which I absolutely love as an investor. So now that we dug deep into SPYI, and I think by now you guys know exactly why I'm such a big fan of this ETF, I wanted to lastly compare SPYI's performance next to JEPI, just because they definitely are somewhat comparable, and see which ETF has performed better ever since SPYI's inception. So if we go all the way back until August 2022, which was right around the time that SPYI started, and compare a $10,000 investment with dividends reinvested next to the JEPI ETF, you can see that the total return on SPYI's end is around 19.44% within this time frame, where JEPI's total return is right around 17.6%, or SPYI's return around 11.6% annually versus the 10.53% annual return that JEPI's offered. Now, I know you're probably saying this doesn't really give us all that much information because SPYI is a relatively newer ETF. It hasn't been around enough to really have any significant data to go off of. But even still, it is interesting that within this time frame, even though JEPI and SPYI have similar strategies, SPYI has pulled ahead, which in my opinion is because of some of the specific strategies that SPYI offers over JEPI. Now, in my opinion at least, I'm still a big fan of JEPI, and I'm not looking to sell any of my shares of JEPI anytime soon, but moving forward, I'm looking to build out a sizable SPYI position because, like we talked about, I think that for a cover call income style ETF, this ETF offers everything and more that I'm looking for. But lastly, now I want to hear from you guys down below. The Schwab US Dividend Equity ETF, known as ticker symbol SCHD, is easily one of the most popular dividend growth ETF choices across the entire spectrum of ETFs for dividend growth investors. And for me personally, I'm definitely included in that list. Because as you see right here across my 7-figure portfolio, I currently own 595 shares of the Schwab US Dividend Equity ETF, and I'm planning to keep buying SCHD throughout the next year until I hopefully hit close to 1,000 shares or more. But in this video, we're going to dig a little bit deeper into this ETF and actually stress test it, go over all this ETF has to offer, and even dig into some important metrics and insights that you're not going to find anywhere else on YouTube. So whether you hold a single share of SCHD or plan to follow my path and own hundreds or thousands of shares, Make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Just to get us all up to speed, let's go over what this ETF is, some of the basics, how this ETF works, and even the methodology that it tracks, meaning even dig into the Dow Jones US Dividend 100 Index. First of all, just to go over some of the basics for those of you that might not be aware, this ETF tracks as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now looking into SCHD's fact sheet, just some of the highlights let's go over. It says a straightforward low-cost fund offering potential tax efficiency, which is great. The fund can serve as part of the core or complement in a diversified portfolio, makes sense. Tracks an index focused on quality and sustainability of dividends, which I said the underlying index is impressive, and it has a rigorous set of screenings for stocks to enter and exit, which is very important, especially if you're like myself and you want to sleep well at night. Now, some other main things about SCHD, it currently has 52 billion plus in total net assets, which is massive. The expense ratio is 0.06%, which is very cheap, and especially if you're like myself that now owns hundreds of shares of SCHD, you don't want an expense ratio that's too high. So now that we're all on the same page, we understand how this ETF works, the ins and outs of the index that it tracks. The next thing that we have to dig into is the performance of the ETF, the holdings, etc., etc. So first of all, as far as performance, it doesn't take a genius to see that over time, at least over the past 13 or so years, this ETF has consistently moved up in price, which is what makes it so appealing to me as a long-term investor. Because even though as a dividend growth investor, I'm obviously very focused on income through dividends and even dividend growth. Over time, over the years, I also want my overall portfolio to move up in price to, of course, increase my net worth long-term. And over the past 13, 14 years, SCHD has over tripled in price, which is pretty impressive. Now, the next thing to dig into is the holding breakdowns and, of course, the top holdings within SCHD as of right now. Now, as of right now, the top sectors are things like financials, healthcare, consumer defensive, industrials, and energy. Now, there are going to be times within the market that some of these top sectors are probably going to flourish more than others. And over the past few years, some of the top holdings within SCHD's breakdown have struggled a little bit, which is why the ETF has lagged the overall market. But I happen to think for long-term investors, because of the methodology that SCHD and the Dow Jones US Dividend 100 Index tracks, I think these sectors are tried and true, and I believe in SCHD's model. Now, the top holdings are things like Chevron, Texas Instrument. We have things like Lockheed Martin, Cisco, UPS, PepsiCo, Verizon, Coca-Cola, Pfizer, Amgen, etc., etc. Now, I hear you, some of these top names are probably not your favorite single stocks, but again, if you trust the process and trust that SCHD is going to continue to have high quality names within the holdings over time that not only pay dividends but also raise dividends consistently, then you, my friend, just have to basically hold on for the ride. So now that we looked at price performance and some of the holdings, I think it's time to talk about the dividend that SCHD has offered historically and even offers today. So the current trailing 12-month dividend yield is just shy of 3.5%. Now, this is one of the main reasons on why this ETF is so appealing to me compared to things like VIG, DGRO, or names of those sorts. Now, this is because as a dividend growth investor, I of course want growth, but I want dividends, and I want dividends today. Some investors are more focused on growth, and some investors are more focused on income. I would consider myself somewhere in the middle, maybe even a little bit more on the income side. So for that reason, SCHD's 3.5% more or less starting yield is offering a lot of cash flow from day one, which definitely satisfies my urge to get money into the portfolio ASAP. Now, SCHD's dividend growth rate, this is another very important metric for long-term holders, and one of the main selling points for this ETF altogether. Now, as you can see over time, the dividends have been getting bigger and bigger, more or less, quarter after quarter, year after year. So much so to the point to where, as of the most recent December dividend, it was 74 cents, which is considerably higher than the previous year at 70 cents. Now, who exactly knows how high the dividends are going to go in the future, but if history were to repeat itself, we're going to see 5 to 10 to maybe 12% increase in dividends year over year, which is absolutely phenomenal, especially as you get into the hundreds or thousands of shares of SCHD long term. Now, this is because as inflation is running rampant and as things are getting more expensive across the board, who doesn't want their dividend income to increase over time? I definitely do. Now, just to give you a quick example, back around this time 10 years ago, SCHD paid around 23 or 25 cents per share per quarter. Now around 10 years later, almost 75 cents per share per quarter. So let's just round it up, let's say about 3 times as much cash flow just over the last 10 years. Now I'm currently a 31-year-old dividend growth investor that's hopefully going to be investing for several decades from now. So my initial thought process and why I grabbed so many shares of this ETF is that if I can stack up as many shares of this ETF today or tomorrow, then 1 year from now, 5 years from now, 10 years from now, 20 years from now, I will be getting not only so much cash flow, but so much cash flow doubled or triple whatever it is today. And especially being a dividend growth investor like myself that doesn't necessarily have a massive amount of cash to invest into the market every single day. Consistently buying into a dividend growth ETF like SCHD that not only pays dividends quarterly, but again, consistently has paid more and more in dividends quarterly, meaning that your money's basically going to work harder and harder for you, creating a compounding effect for your overall portfolio. At least that's the idea here. So now that we went over all of that, there's only one last thing to do within this stress test, and that's to compare SCHD's performance next to the benchmark SPYI or the S&P 500. So if an investor was to have invested $10,000, and this was back in 2011 when SCHD started, that $10,000 with dividends reinvested would have turned into $43,800 if you would have invested into SCHD. Now, if that investor invested that same $10,000 on that same exact day into SPYI, they would have turned that 10K into 51.3 thousand or 14.02% average total return annually compared to SCHD's 12.57. So although SCHD does have a total return so far, if dividends were reinvested, of 338.16%, which I don't think any of us would be complaining about. If an investor would have at that same time bought SPY, they would have been up more considerably. Now I think it goes without saying that if you or I returned 12.5% or 14%, either way that's a very successful investment long term. And you have to give SCHD some brownie points because over time, the dividends that were paid were bigger than that you would have got of SPY. But even all the amazing aspects that SCHD does offer to investors like myself, investors would have been much better off just buying SPY and holding on through the long term. Now, even though that's the case, that does not deter me for a second from buying another share of SCHD every single day throughout this next year. And this is once again because SCHD aligns with my goals of having a dividend growth ETF that pays a substantial dividend from day one. But it goes without saying that there's tons of other high quality dividend growth ETFs across the market, like SPYI, like VU, like DGRO, just to name a few. Investors are finally seeing the biggest dip in the stock market that we've seen for over a month now. And with this dip, there are of course some high quality dividend paying stocks on sale, but the question is which ones are they? Stay tuned to find out. Real quick for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the first dividend paying stock that could be offering a buying opportunity, and keep in mind all these stocks that we're going through could be a buying opportunity because they are offering a larger than normal dividend yield, which in theory could allow investors to lock in a great starting yield and sail off into the wind. But the first dividend paying stock that I'm actually a holder of that could be offering a buying opportunity is ticker symbol ENB or Enbridge. Now, if you want exposure to energy, oil, gas, storage, and transportation, there are going to be a few names in this video that could be offering a buying opportunity, and unless I'm mistaken, I own all of them. But Enbridge is offering a starting yield of 7.89%, which as you can see right here, if you look a little bit closely, this is the highest dividend yield towards the higher end that we've seen in the last 5 years. Now, Enbridge dividend safety score, according to Simply Safe Dividends, is a 70, so the dividend is relatively safe. Enbridge is currently trading in the mid 30s, so not the cheapest that we've seen over the past few years, but it is creeping down to that layer. Now, Enbridge is pretty low beta at 0.71%, which I love as a long-term dividend growth investor. I don't love seeing my portfolio whipsaw on a daily basis. As far as dividend growth goes, Enbridge, although offering a nice starting yield, has historically offered some decent dividend growth, at least over the last 20 years. We're talking 11% per year. On top of that, Enbridge has 28 years of consecutive increases, 71 years in a row without reductions, so this oil dividend stock should be safe unless we see some crazy black swan event. The next dividend paying stock that could be offering a buying opportunity also in the energy and oil and gas storage transportation space is TRP or TC Energy. Now, I've owned this one for a while. I think I just have a few shares, but it hasn't really done me wrong since. TC is offering a 7.84% forward yield. Dividend safety score is a little bit lower than that of Enbridge. Also is very low beta. And as far as dividend growth goes, there is some dividend growth, although it's pretty slow, which is sort of what you can expect from some of these higher starting yielders. But as far as dividend safety goes, all we have is history to go off of. We have 23 years without a reduction and 23 years of growth, which I honestly don't think is bad whatsoever. As far as dividend increase cadence, we're looking at around 3 cents every year or so, which again is not terrible considering you're getting almost an 8% starting yield. So if you of course want exposure to energy, this one could be offering a buying opportunity. Next, one of my largest holdings, Verizon, is also possibly offering a buying opportunity. Even though Verizon has came back a little bit over the last year, it still is offering a 6.7% starting forward yield. And investors, including myself, are hoping that most of the pain that Verizon has felt over the last year and a half is at least hopefully over. Now, Verizon's dividend safety is a 70 on the safety score. Relatively safe dividend, probably not the safest across the entire market though. Verizon trading in the sub $40 range though is too cheap for some investors to pass up. I've been seeing across Twitter, some of the dividend community has been grabbing some shares of Verizon. Verizon's beta is very low at 0.42%, which is one of the main reasons on why I actually purchased a substantial portion of Verizon years ago. But as far as dividend growth goes, Verizon's dividend growth is very slow, although it has been pretty consistent. We have 40 years of uninterrupted dividends and 17 years of dividend increases, but every dividend raise is only around a few cents. So you're probably not going to get substantially rich off the dividend increases with Verizon. But if you are looking to build out sort of a riskier, in my opinion, communication position in a single low beta name, Verizon could be one to look into. The next dividend stock that could be offering a massive buying opportunity, trading towards the lower end of what we've seen in a long time now, is PFE or Pfizer. Now, I owned Pfizer way back in the day. I since sold it a while back and haven't owned any shares of Pfizer since. But as far as yield goes, we have a 6.5% forward yield, which is massive considering what we've seen historically out of this one. So investors could look back and say that was a horrible investment if they bought some shares of PFE, or they could look back and say this was an accidental high yielder, which was a gold mine. But trading the $25 range, this is back to where this one traded years ago. 75 in the safety score, so the dividend is said to be pretty safe as of right now. Very low beta at 0.38%. Dividend growth is pretty slow, 5% over the last 20 years, 4% over the last 5 years, and then just as of recently, we're seeing very, very tiny increases, about a penny. We have 13 years without a reduction and 13 years with consecutive increases. This is one to definitely keep on your watch list. The next dividend stock that could be offering a buying opportunity is WP Carry, or ticker symbol WPC. WPC is offering a 6.29% forward yield, a 70 on the safety score. WP Carry has been in my portfolio for a few years now, and although if you're familiar with this one, they did do that office spinoff, which did drop the dividend significantly, but you were of course given shares of the new spinoff, which I honestly wasn't really that big of a fan of. But all in all, WPC's portfolio is pretty bulletproof and is definitely a REIT to look into. But if you want more exposure to real estate, I think it's definitely worth having on the watch list. The next single stock that's on sale as of right now, in my opinion, is Realty Income, ticker symbol below, offering a 5.93% forward yield, a dividend safety score of an 80. Realty Income's dividend is about as safe as it comes, if you ask me. Realty Income is one of my largest positions. I've owned Realty Income for several years now. I own well over 2,800 shares. Realty Income has a low beta. Dividend growth is sort of slow, around 3% more or less per year. But Realty Income's dividend streak is without a doubt very impressive. 55 years without a reduction. We have 29 years of consecutive increases. And the monthly paying dividend stock has some of the best properties across the entire world in their portfolio. Ticker symbol below has been on my daily watch list for years now and will continue to be. The next single stock that could be offering a buying opportunity, another REIT, is Triple N or Triple N REIT. Now, Triple N's also been in my portfolio for several years now. It's sort of maybe my second or third favorite REIT after Realty Income. With this one trading in the low 40s, offering a 5.54% forward yield, the dividend is considerably safe, the beta is very low, and the dividend growth is somewhat similar to other REITs. But with Triple N's 34 years of consecutive increases and 36 years without a reduction, this is another one where you are getting exposure to super high quality real estate, if that's of course what you're looking for. And speaking of super high quality real estate, PSA or Public Storage is also on sale right now, offering a 4.41% forward yield, dividend safety 96, which is super impressive. PSA's dividend growth has been massive on the last few years, and in the last few years, investors saw that firsthand. PSA does have 43 years without a reduction, and if you want exposure to high quality self-storage spaces, PSA is definitely one to look into. The final last single name that is offering a buying opportunity potentially is Bristol Myers or ticker symbol BMY. BMY offering a 4.97% forward yield. Dividend safety is there at a 70. Dividend growth is actually not all that bad with a 5 to 7% dividend growth rate on the latest year / the last 5 years. Bristol Myers has been beat up quite a bit over the last 1.5 years and has been on my watch list, although at this point I haven't myself grabbed any shares. So there we have it. Those are 9 different dividend paying stocks that are offering a potential buying opportunity as of right now, as the market is continuing to be shaken up. Out of all the different single names we went through in this video, if you only had to buy one, say today or tomorrow, which stock would it be and why? Drop the ticker symbol in the comments down below. If you guys enjoyed this video, make sure to please drop a like on it, subscribe for more videos like this in the future, and make sure to go down below and grab my dividend tracker and ebook today. Now, I made a quick little list right here for some of the things I'd look for in regards to what the perfect dividend growth ETF would be if it exists, of course. Now, the perfect dividend growth ETF would have to have all these things, not just a few of them. It would have to have every single one of these things on the list in order for me to consider it to be the perfect dividend growth ETF. Now, this ETF is going to have for one, a positive price return long term, because even though as dividend investors we're searching for cash flow that grows over time, we also want our assets to get bigger and bigger as time goes on. Next, this dividend growth ETF is going to have to be heavily diversified, because again, for an asset that you want to buy and hold forever potentially, diversification is going to be key and is going to help you sleep well at night. Now, this perfect dividend growth ETF is also going to need to have a super solid top 10 holdings. I'm talking 10 stocks you'd be happy to hold on to for not 1, 5, but 10 plus years even. This ETF is also going to have a decent starting dividend yield, no 0.5 or 0.7%. We need a little bit more cash flow from day one. Then my favorite metric, this dividend growth ETF is also going to need to have dividend growth, a history of a dividend that's getting bigger and bigger as time goes on. Now, if an ETF has all these things, then as a bonus, I also add it could even pay out a dividend monthly, because of course a quarterly paid dividend is not bad by any means, but a monthly paid dividend long term, when some of us want to retire and use some of these dividends to pay for bills and things, it's going to just help keep our cash flow on a consistent basis a lot more neat. Now, I do have good news for you. I did find a dividend growth ETF that crosses off every single one of my qualifications when it comes to finding that perfect dividend growth ETF. Now, if you want to learn a little bit more about which ETF this is, stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the perfect dividend growth ETF that crosses off every single thing on my list is DGRW, or the Wisdom Tree US Quality Dividend Growth Fund. Now, it says right here in the Wisdom Tree website, Wisdom Tree US Quality Dividend Growth Fund seeks to track the investment results of dividend paying large cap companies with growth characteristics in the US equity markets. Now, I know I had a lot of qualifications on my list, but I'm going to show you that DGRW has every single one of those crossed off and more. So first off, we talked about positive price performance long term, because again, even though us as dividend investors, we definitely favor income and of course cash flow, but like I mentioned, we also want our assets to be going up and up and up over time. And DGRW has done exactly that, considering just around 10 or 11 years ago, this ETF was trading around $24 per share, and now it's trading above $71. That's up around 190% just as far as price return, and that's just over the last 11 or so years. Next, a very important aspect, especially for a buy and hold forever style long-term dividend growth ETF, would have to be the holding breakdown. Now, we talked about diversification and top 10 holdings. DGRW has around 300 different holdings, which is heavily diversified. Now, the reason I like that is because even if 1, 2, 3, or 5 different stocks within the entire ETF have a bad year, bad quarter, again, long term, being that diversified, as long as the major players in the ETF perform well, the ETF is most likely going to continue to flourish. Now, the holding breakdown for this ETF is very favorable for dividend investors that, of course, want some growth exposure. With technology being the number one sector, that of course is going to give you that growth exposure, a little bit higher beta, but it's not necessarily too much of the fun, which I love. Healthcare is also great. We also have industrials, financials, consumer defensive, and consumer cyclical making up the rest of the majority of the ETF. Now, top 10 holdings is something very important to me because, again, if you are going to invest a substantial amount of money into an ETF, and this is for any ETF for that matter, you're going to want to look at the top 10, top 20, top 30 holdings, and at least have an idea of what companies are in the top, and ask yourself, would I be okay with buying these companies on their own? And if not, of course, dig a little bit deeper into that. But with DGRW, the top 10 holdings make up of around 37% of the entire ETFs. So you are getting a lot of exposure when it comes to just these top 10 names. But names like Microsoft is definitely a stock that I definitely have held in its own, and Microsoft is 8% plus of this entire ETF. So this ETF is very exposed to Microsoft and Apple, for example, which I absolutely love, considering I'm very bullish on both of these. The ETF is also made up of a large portion of AbbVie. We have Broadcom, Johnson & Johnson, of course, Procter & Gamble, the Home Depot, Coca-Cola, Nvidia, Pepsi, and others. Now, even if I were to be brutally honest, these are all for the most part names as a dividend growth investor that I would not mind having as a single standing stock on my portfolio, but honestly I love the fact that you get some diversified exposure into these and more by investing into DGRW. So now that the price return checks off when it comes to DGRW, we talked about the diversification and the top holdings and even the top sectors, it's now time to look a little bit deeper into DGRW's dividend, dividend growth, dividend safety, etc. So DGRW does currently offer a trailing 12-month dividend yield of around 1.7%. Now I said that in my qualifications for finding the perfect, quote-unquote perfect dividend growth ETF, that ETF would have to have a decent starting dividend yield, and what I meant by that is I don't want to invest into something that has a 0.3% or a 0.5% starting dividend yield, and even though it's not an ETF, I'll give you an example. I'm talking about something like Apple that currently offers a 0.52%. Now I get it, you're not buying Apple stock to become a millionaire off the dividend, you're buying Apple of course for growth. But in the context of finding a dividend growth ETF that you're going to hold long term and get rich, hopefully not only the price performance, price return, but also off the cash flow that's paid to you consistently. 1.7% in my book is pretty decent as a start. But the other metric that's very important to me, very, very important, is dividend growth rate. Now, dividend growth rate is basically how much in dividends a dividend stock or ETF pays you year over year. Now, as you can see, DGRW for the most part has had some very significant, pretty positive dividend growth rates. Although there has been years where the dividends have dipped down a little bit, but then from there they've always went up. And this sort of wonky dividend growth is partially due to the fact that DGRW does pay dividends on a monthly basis. But even though DGRW does pay dividend monthly, they pay a different frequency where there's going to be a small dividend, a larger one. And as you can see right here, it's sort of sporadic. But even with the sort of sporadic nature of the dividend paid from DGRW, you can see that on a monthly basis. Hint, I said monthly basis. The dividends have been getting bigger and bigger over time pretty consistently. Now that brings me into my bonus qualification. I did say earlier that if said perfect dividend growth ETF also paid out a dividend on a monthly basis, that would be a bonus because of course if you're anything like me and you are a dividend growth investor that at some time in the future wants to use at least partial if not all of your dividend income to pay for bills, pay for travel, pay for whatever it might be, a dividend that's paid on a monthly basis is going to be much more convenient than that of a quarterly basis, and that's just because most bills are due on a monthly basis. Now with that, DGRW does pay a dividend on a monthly basis and has consistently since the inception of the ETF. Now just to play devil's advocate, I would say that because the dividend income is sort of all over the place and you're not really going to get a consistent, steady dividend payment on a monthly basis when it comes to DGRW, that is I guess sort of a negative in the context of you wanting to retire and have the dividend income pay you consistently to cover your bills, etc. Now lastly, I thought it'd be kind of fun to compare DGRW to some of the other super high quality dividend growth ETF or indexes, of course, and showcase the total return or how much price return plus dividends included. Each of these have returned over multiple different time frames. Now just a side note here, VIG, SCHD, DGRO, S&P 500, and DGRW. In my opinion, these are all more or less good options for a long-term investor, at least in my opinion that is. But on the 1-year time frame, DGRW, for example, has a total return of almost 16%, S&P 20%, DGRO 9%, SCHD 2%, and VIG 12%. So DGRW, at least in that time frame, is towards the higher end. On the 3-year time frame, DGRW has a total return of 40%, S&P 27, DGRO 28, SCHD 29, and VIG 30. So in the 3-year time frame, DGRW has crushed pretty much all the other competition, although on a 3-year time frame, these have all done pretty well. But when it comes to the number one best of all time dividend growth ETF, I want to hear from you guys down below. Which dividend growth ETF do you think is number one? Drop the ticker symbol in the comments. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.